Hey, good morning, everyone. Marty Mazzora here. It is the 18th of January, 2026, with a market and economic update for you. Today, we're going to run through a few of our notes from last week in our internal log, and I can keep it pretty quick, I think. Also, I want to look at stocks, the dollar, treasury yields, precious metals, and a quick look at the copper chart. I have thoughts and comments on each that I'd like to share with you. So to begin with, note that I put in here just the other day, the 15th, it had to do with precious metals. I have high conviction that metals, silver in particular, are very ripe for a not small correction in the near term. BCA does an analyst meeting every morning that I listen to live, and that morning they had mentioned that as well. And so I sympathize with what they have to say here. Silver, copper, and energy prices experienced sharp reversals after the administration paused tariffs on critical metals. So my point being, what is really driving the speculation under the price? Silver in particular above 90 was followed by a steep pullback, yet prices remain elevated. And I think even that day they closed way off their lows and rallied the next day, if I recall correctly. Tariff uncertainty has disrupted global flows and inventory, triggering speculative positioning and short squeezes. At the same time, industrial demand for silver in particular declined in 2025. It's big in solar. We're actually still bullish long-term on silver, although we did cut our position way back at the beginning of this year just because of the craziness of this rally as we see it. But even in solar, they cut back where manufacturers are actively having to substitute away from silver due to high prices. Truly, lately, it's been sentiment more so than supply-demand balances. And from their discussion a day before, sharp rise in copper and silver prices prompted debate over whether demand is being driven by AI-related data center construction. The dominant view was that this narrative is overstated. Chinese imports of refined copper have been contracting, indicating that China is not the marginal driver of the rally. Instead, price strength reflects U.S. inventory accumulation ahead of potential tariffs. Once tariff policy is clarified, incentives to front-load imports should disappear. That's where I think we're going to really begin to see some downside movement in these metals. Speaking of tariffs, just yesterday, the president on social media announced that he is imposing an additional 10% tariff on European partners, particularly ones who are pushing back against the U.S. taking over or, I guess, purchasing Greenland. And those tariffs are to go into effect on February 1. And then I guess by June, they're supposed to be increased to 25%. Europe is pushing back with regard to a pending trade agreement with the U.S. So they are suggesting that they will not, after all, sign that agreement while this threat of additional tariffs is elevated in what I'll call the synthetic or one synthetic market, where investors, or I guess traders, trade what amounts to a derivative on certain averages like the Dow and the NASDAQ 100. Just gives you an indication for sentiment over the weekend. I wouldn't trade on those very thinly traded markets, very speculative, but they're interesting to look at. And I noticed this morning in this one particular facility that I follow, the bets on the movement in the Dow had it down 355 points and had the NASDAQ 100 down about 1%. Also, one way that I track things over the weekend is, since crypto trades 24/7, I can track gold priced in certain cryptocurrencies. And gold is up about 1/3 to 0.5% last time I checked. That's essentially right now hinting what the market would look like if it were open right now. So nothing too dramatic to the downside in equities or to the upside in precious metals, but certainly a reaction. Macro Research Board, one of our premium research providers, they did what I thought was an excellent report on the state of affairs with yields in particular and inflation and how it's viewed and how it's treated in the markets. And I think just an excellent essay on human nature. They compare the current setup to the 1980s. Now, in the 1980s, the world was coming off of a period of very high inflation, very stubborn, very structural inflation that was going on really for several decades. And when the world began to change, when Margaret Thatcher and Ronald Reagan showed up on the scene and really promoted more supply side, more capital friendly regimes, if you will, or a way of conducting policy, deregulation, cutting corporate taxes and so forth, inspiring investment in new technologies, etc., true disinflationary forces were getting embedded into the structure of the global economy. But because people had not remotely in recent history experienced anything like that, they didn't believe it. So anytime you would see a rise in inflation, a counter-trend rise as inflation was following, you'd have the Federal Reserve and other central banks jumping right in and tightening monetary policy. Bonds would sell off, yields would spike, and so forth, because they just believed that, the disinflation was transitory and that inflation, because it's always there, would come roaring back. Well, as time went on, it became clear that that was not the case, that disinflationary forces were now dominant. So then we got into the 90s and the 2000s and beyond, and we had, COVID, right? Remember, the Fed, for example, just really couldn't believe that inflation could be sustained above ultimately their 2% target. So transitory became the buzzword. This is just transitory. It's not lasting, because everything in their adult lives and in their professional lives just suggested that inflation had been whipped and it would be whipped forever. We've been making the case for quite some time that we're now entering into the next labor-friendly, populist regime, which is inherently inflationary. And what do we have? Again, inflation is transitory. The folks at BCA, who I have the utmost respect for, by and large just don't believe that inflation is going to be much of a problem. And they may be right in 2026, but I suspect that as we get further into the year, they may very well be wrong. And again, with all due respect to those very smart people, it just appears to me that recency bias or ingrained, modern history bias, if you will, is ingrained, so to speak, and they just have a tough time fathoming that we actually could see inflation run at 3%, 4%, 5%, far into the foreseeable future, or far into the future at all. I would also argue, as I have on the blog and other people have as well, that really inflation is how the U.S. cures, large debt problems. That's the story that I've told multiple times here around World War II in 1943, where yield curve control was implemented. We knew that there was going to be massive borrowing by the Treasury, massive refinancing of all that short-term war debt, and we can't have inflation coming back strong and therefore interest rates coming back when they're going to be running massive deficits and refinancing massive amounts of government debt. Debt to GDP at the time was about 116%, the only other time in history where we were, like we are now, above 100%. But implementing yield curve control, where the Fed essentially stepped in and bought up all the Treasury issuance necessary to keep the curve flat at about 2.5%, allowed the economy to run hot, right? GDP, we factor that nominally. So whatever the rate of inflation is, let's say if all else were equal, if you and I bought all of the same units of things and services that we did the year before, but inflation was 5%, the price went up 5%, well, then GDP grows by 5%, right? If we can keep the cost of financing down and keep inflation relatively hot, right? Keep the economy chugging along, you wake up 9 years later, 1952 in that example, with debt to GDP well below 100% and a very manageable scenario going forward. No debt got paid off. The debt actually rose, but the economy grew faster than the debt. Hence, Scott Bessent's 180 that he did last year, going from we're going to keep deficits low and shrink the size of government. Well, the markets tested that and they failed, and then they flipped it on its head and said, oh, we're going to grow our way, i.e. spend our way out of this problem. Now we're running, 5-6% deficits, the kind of deficits you never run, at least historically, unless you're in the bowels of recession. And we're not, obviously, which that kind of spending and all else that's going on suggests to me that recession odds are significantly reduced, at least as we head into 2026. I think there's still lots of risks out there. And it could be that, akin to the late 90s, that in a reflexive sense, that if we do get some real weakness in the equity market, for example, that could be what causes what I would expect to be a somewhat mild recession, if indeed that were to occur. Okay, so that's what that MRB article was all about. Here I say I sympathize with Jamie Dimon's macro view right here. He said the U.S. economy has remained resilient while labor markets have softened. Conditions do not appear to be worsening. Meanwhile, consumers continue to spend and businesses generally remain healthy. This could persist for some time, particularly, as I keep saying, with ongoing fiscal stimulus, deregulation, yada, yada. However, as usual, we remain vigilant and markets seem to underappreciate the potential hazards. And that's why we continue to hedge and be incredibly diversified right here. And then I threw in just a chart of our latest scoring of our PWA index. You can see we're now above the zero line, which means that recession odds are notably lower than they were, back in here. And it's been a year since we've been above the zero line. So we'll see how it all plays out. I'll keep reporting as we go. Okay, quickly to the charts. The S&P 500 one-year daily price charts. As you can see, folks, we pretty much are where we were back here in October, right? So 2+ months, almost 3, with really the S&P staying right there. Broke above this line here into new all-time high territory, threatening that right now as we speak. And if I draw a better trend line here, that's the trend line right there. If that breaks, that's going to be a sell signal. You break that 50-day moving average, and technically speaking, that would be quite the sell signal. Odds favor some downside here. Again, I keep saying that reason to be relatively bullish for the start of the year. Right now, though, the technicals are suggesting that at some point, either momentum's going to have to really pick up as we break out to the upside, or you need to do some shaking out of these levels to the downside. And that's reflected in the moving average convergence divergence clearly, and that's about to be a sell signal right there. And then the relative strength index, you can see that the underlying momentum has been waning here. As for the NASDAQ 100 index, as I told you last time, we're in a symmetrical triangle, which is something that the market tends to break out of somewhat violently, if you will. The momentum is suggesting that maybe a downside breakout favors an upside breakout. If what I told you earlier about the synthetic market over the weekend, it holds true, we're going to see that become more of a sell signal on Monday. And same thing, relative strength index is showing waning momentum as well. As for the U.S. dollar, remember we are long-term bears on the dollar. That's a thesis that we think is quite strong. However, I have been saying that it would not surprise me at all to see some strength in the dollar right here. It'll be interesting to see how the dollar reacts to the weekend news. Technically, it should go up, but it hasn't always been rising on tariff news. You would think that treasuries would get bought on the uncertainty. So we'll know here come Tuesday. Monday's a holiday. And you can see that the momentum is really picking up here in the dollar via the MACD and the relative strength index. As for yields, you can see they popped above what has been pretty strong resistance all the way back to September. This is how technicals work, folks. You notice on this one-year chart, as the yields began to drop to around that 420 mark, It was support for most of the year, actually, or at least half of the year or so. And then once it broke down, what was once support becomes resistance and established more support right here at about 4%. So we'll see how that plays out in terms of momentum. You are getting just a nascent buy signal right here. You do have a bearish divergence, though, in terms of the slope of the MACD and the RSI. It'll be interesting to watch. Again, intuitively, the way the world seems to work or has worked for a very long time, the dollar would get some love here on Monday if the uncertainty persists, and yields would come back down as people buy treasuries. So we'll see. I'm not predicting anything. It's going to be interesting to watch that. Gold continues to hang out here at all-time highs. As I mentioned a bit ago in the crypto market, gold is rallying a little bit here today on that uncertainty. Gold is way out over its skis. We are hedging our position. We'll feel it if it does drop dramatically, but we are protected with the put option, so it can't get too bad. But, I mean, the momentum indicators are flashing massive warnings. This is GLD, the gold ETF daily chart. Remember, I've been showing you the monthly chart of the gold price itself all the way back to the 70s. This is the relative strength index. Above 70 is considered overbought. We have not been this extended since the 70s. And in the past, as I've illustrated for you, when we get overbought on the monthly chart for gold, you tend to get some pretty notable corrections. You can see 21 and 44%, 57%, 33%. The smallest one was on this overbought spot right here, which was, call it 9%, but then it was followed by a 26% decline. 42% here coming off of this 2012 level, 17% here more recently. So look for gold to give some back in 2026, I suspect. Silver chart just has gotten stupid, as I talked about earlier. Way up here at these levels, rolling over, still even overbought a bit after coming off a little bit. Could very well just keep on ramping for a while. Once certainty shows up and fundamental reality shows up, I think silver has got some significant downside in it, and I would be a buyer, back in this range here. And again, we cut our exposure notably, so we're in a position to buy it back if indeed price accommodates us. Same thing for platinum, and we treated it the same way. Platinum, you can see, is trying to battle here. These are kind of one-day island reversal patterns, which tend to be not good patterns here. But, again, we keep fighting back there and bumping up against that all-time high. Stark bearish divergences of momentum with a sell signal right there on the MACD. Copper, wow. And again, I talked a bit about copper at the beginning of my monologue here. I right up here at 13,000. You break below that level, quite a ways down here to the 50-day moving average, and just rolling over in terms of momentum. Big bearish divergence on the RSI, nascent sell signal here on the MACD. Very, very bullish copper long term, but that is really pricing a lot in right there. We also cut our exposure to copper by way of the miners exposure, which has continued to be amazing in 2026. But folks, these are areas that we anticipate some weakness going forward for a while. But maybe not Monday, right? Or maybe not next week with all the uncertainty. Silver and gold could start the week very strong. Ultimately, as I've shown you here, they feel a little bit like Wile Coyote, who's run off the side of that cliff and just doesn't know it yet. Anyway, folks, as you can see, diversification is critical in this kind of market, and we think some other kinds of dynamic hedging, which we're doing, are very important right here as well. But taking the other side of the coin, you've got a tremendous amount of fiscal oomph that's going to be pushed into this economy over the next few months. If you dovetail that with the opposite of what we saw yesterday and more of an alleviation of the tariff threats and a little calming down of geopolitical risks and so on, it could be special for a little while for risk assets until inflation starts showing up. In that scenario where we get some calm followed by fiscal stimulus, I think you're going to see prices begin to turn the corner back to the upside, and yields are going to have to follow. And that may be a second half of the year phenomenon if that's indeed where this is going. So I will leave it on that. Hope you have a great rest of your weekend and holiday on Monday, and I'll talk at you again next week. Take care. Bye-bye.